Hey there! Today we're going to talk about a very important institution that plays a key role in our economy, the central bank. So what is a central bank? A central bank is a financial institution that is responsible for managing a country's monetary policy. Its primary function is to regulate the supply of money and credit in the economy, which has a direct impact on things like interest rates, inflation, and economic growth. The role of central banks lies in three pillars: regulating the money supply, maintaining financial stability, and managing the foreign exchange reserves. Let's get into each one of these. You may have heard of the term money supply before, which refers to the total amount of money in circulation in an economy. A central bank has the power to control the money supply by influencing the amount of money that banks can lend out to individuals and businesses. Let's see how they manage to. Open market operations. This is the most commonly used tool by central banks to control the money supply. Through open market operations, central banks buy or sell government securities, such as treasury bills or bonds, to banks and other financial institutions. By purchasing securities, the central bank injects money into the economy, which increases the money supply. Conversely, by selling securities, the central bank reduces the money supply. Reserve requirements. Reserve requirements are the percentage of deposits that banks are required to keep on reserve at the central bank. By increasing reserve requirements, central banks reduce the amount of money that banks can lend out, which reduces the money supply. Conversely, by decreasing reserve requirements, central banks increase the amount of money that banks can lend out, which increases the money supply. Discount rate. The discount rate is the interest rate at which banks can borrow money from the central bank. By increasing the discount rate, central banks can make it more expensive for banks to borrow money, which reduces the amount of money that banks can lend out and reduces the money supply. Conversely, by decreasing the discount rate, central banks can make it cheaper for banks to borrow money, which increases the amount of money that banks can lend out and increases the money supply. Forward guidance. Central banks can also use forward guidance to influence market expectations and indirectly control the money supply. Forward guidance involves providing guidance or signals to markets about the future direction of interest rates, which can influence the behavior of investors and financial institutions. By providing forward guidance that signals a future increase or decrease in interest rates, central banks can indirectly influence the money supply. That's how banks control the money supply. Let's see now how central banks are maintaining financial stability. Central banks maintain financial stability to safeguard the economy and preserve public confidence. By closely monitoring and regulating financial institutions, they ensure the soundness of banking system, minimizing the risk of failures, and maintaining the flow of credit. There's 4 different ways to maintain financial stability, starting by the first one, which is lender of last resort. Central banks act as the lender of last resort, which means they provide emergency funding to banks and other financial institutions during times of crisis. By providing liquidity to the financial system, central banks can help prevent bank runs and maintain financial stability. During the global financial crisis of 2008, many central banks provided emergency funding to banks and other financial institutions to prevent the collapse of the financial system. Banking supervision. Central banks also supervise and regulate banks and other financial institutions to ensure their stability and prevent excessive risk-taking. They set prudential regulations, such as capital requirements and liquidity standards, to ensure that banks have enough resources to weather financial shocks. They also conduct regular stress tests to assess the resilience of banks to adverse economic conditions. Financial market operations. Central banks can use their balance sheets to stabilize financial markets during times of crisis. For example, during the COVID-19 pandemic, many central banks purchased corporate bonds and other assets to prevent a credit crunch and stabilize financial markets. International cooperation. Central banks cooperate with each other and with international organizations to maintain financial stability. The Bank for International Settlements, BIS, for example, facilitates cooperation among central banks and promotes the stability of the global financial system. Now let's explore how to manage the foreign exchange reserves. Central banks manage foreign exchange reserves to fulfill multiple objectives. Reserves provide a buffer to address external shocks and maintain exchange rate stability. By having a sufficient reserve stockpile, central banks can intervene in the foreign exchange market to stabilize their currency's value and prevent excessive volatility. Additionally, reserves enable central banks to meet international payment obligations, ensuring smooth trade and financial transactions. The most common ways central banks use to manage the foreign exchange reserves are four, starting by diversification. Central banks diversify their foreign exchange reserves to reduce the risk of exposure to any one currency or asset class. They hold a mix of currencies, including the US dollar, euro, Japanese yen, British pound, and Swiss franc, among others. They also hold a mix of asset classes, including government bonds, corporate bonds, and equities. Active management. Central banks actively manage their foreign exchange reserves to generate returns and minimize risk. They use a range of investment strategies such as active currency management, duration management, and credit risk management to achieve their investment objectives. They also employ external asset managers to help manage their portfolios. Interventions. Central banks intervene in the foreign exchange market to influence the value of their currency. They may buy or sell their own currency or foreign currencies to affect the exchange rate. They may also use forward contracts, options, and other derivatives to manage their exposure to currency risk. International cooperation again. Central banks cooperate with other central banks and international organizations to manage their foreign exchange reserves. For example, they participate in the International Monetary Fund's Special Drawing Rights (SDR) system, which allows them to access a pool of reserve assets that includes the US dollar, euro, Japanese yen, British pound, and Chinese yuan. Overall, central banks manage their foreign exchange reserves to support their monetary policy objectives and maintain financial stability. So there you have it. A central bank is a critical institution that plays a vital role in maintaining economic stability and growth. I hope this video has helped you understand what a central bank is and why it's important. Of course, there's a lot more stuff and details to mention about central banks, but the video will take forever. We just explain the important things. If you want us to get into depth on anything we mentioned in the video, or just a topic you want to know about, you tell us in the comments below. Don't forget to like the video, subscribe, and activate the bell ring for more content like this. Thanks for watching, ladies and gentlemen. See ya!